let's move to the next level of analysis. We started off by looking at economic analysis, the next level of top-down investing. So we start by looking at the global economy, looking at where various countries are in terms of their business cycle, their economic cycle. We took a look at the U.S. economy, and now let's take a look at the stock market, doing a fundamental analysis of the stock market. Oh, it would help if I put my clip in here. So this is going to go. There we go. That's what I want to do. Okay. So first of all, why should we do a fundamental analysis of the stock market? Well, studies indicate that up to 90% of the return generated by a well-diversified portfolio, I just want to make sure y'all can see the wording there, and 50% of the returns of individual stocks are due to the influence of the overall market. Okay? So the market is very powerful in terms of the influence it has on portfolios and on individual stocks. So by assessing factors that affect an entire asset class, such as stocks, remember asset classes, stocks, bonds, commodities, real estate, private equity, things like that. These are asset classes. An investor can get a good idea of whether the environment will be conducive for investing in that asset class. So we're fine-tuning. We're still at the point where we want to fine-tune what our asset allocation should be. Where should we be in that range in the asset class? My phone is ringing. Hold on here. Let's see who it is. Just wanted to make sure that it was not the tire company that's putting a new tire on my car because I rolled over a nail. All right. In other words, since the pull of the market is so pervasive, it's so powerful, it is so important, it's so influential, it makes sense to consider how the market might perform over the intermediate term. So what do we think is going to happen in the market? And again, we're in 2018, and we've had a very long bull market run. Interest rates have come down over that period of time, and now interest rates are starting to come back up. Interest rates are a very important factor that affects the market, and so I have been watching very closely interest rates and the stock market. And as I go to rebalance my clients' portfolios, I have moved to the lower end of the range because of where we are in the cycle. Okay? At the same time, you're pondering issues that might pertain to individual stocks. So as you're picking individual stocks, you're also considering where you think we are in the economic cycle, what you think will happen to the market, and how that will impact individual stocks. Okay? Remember that even if you're right about stock-specific issues and matters, in other words, you've done your research about companies, even if you're right, okay, a negative move by the market could impair or nullify your returns from individual stocks. So even if you pick a really good stock of a really good company and you're right about the news that comes out, if the market goes down, it will pull that stock down along with it. Let me check and just make sure that we are operating. We're going to get a close-up here. Yes, everything looks good. Let's keep going. Let's keep going. Y'all don't be talking behind my back. Don't be talking behind my back. All right. Okay. So how do we do a fundamental analysis? Well, keep this in mind. The stock market is nothing more than a collection of individual stocks. It's a bunch of stocks. Therefore, fundamental analysis of the market is done the same way as it is done for an individual security or for an individual business, if we were going to value an individual business. There are two variables that must be assessed and then forecast in order to come up with a value for a business or for an individual stock or for the market. Okay? And these two variables are fundamentals. Got to forecast those fundamentals. Revenues, cash flow, earnings, dividends, book value. Okay? And then valuation. Valuation is either a discount rate that you use to find the present value of these future fundamentals, or a multiple. So valuation is the discount rate or the multiple, and the fundamentals. All right, to forecast fundamentals, you start with the most recent numbers, then assess factors that will change the recent numbers going forward. So we have historical data that we look at. That's our starting point. And then we look at factors that will change that data going forward. The publishers of various market indexes do publish historical data for the fundamentals. We can find the data for what we have here: revenue, earnings, book value. Okay? For example, see the table below that has annual data for the S&P 500. So here we go. Revenues, earnings, and book value for the S&P 500. Okay, going back several years. So the question is, what will 2016 look like? What will 2017 look like? All right, note the declines in earnings and book value that occurred in 2008. So we're way back here in 2008. And in particular, earnings just dropped off a cliff. Okay? Book value dropped. Okay? And the drop in revenue in 2009. So the market, the fundamentals were not growing back in 2008 and 2009. Okay? And this was due to the financial crisis that hit in 2008 and 2009. All right. Also notice the quick rebounds that happened. So revenues dropped, and then boom, they came right back. And within 4 years, revenues at S&P 500 companies exceeded where they were in 2007, and earnings exceeded where they were in 2007, which was the prior peak. So we had a terrible 2008 to 2009 period, but companies and the markets quickly rebounded. All right, as you review fundamentals, you must explore the big variables that drive those fundamentals. So let's take a look at some charts of fundamentals. All right? And so this is a chart of GDP growth. And notice how GDP goes negative. We had 4 consecutive quarters, we had a full year of decline in the economy. We had a recession back here in 2009. A big drop off, 2008, 2009. A big drop off. And then, since then, we've recovered. And looks like the average rate of growth somewhere around 2%. Looks like. We had a few good quarters in between. Okay? Need to update this chart a little bit. This goes through 2015. See where we are. I'll update that chart. We can update that chart. Here's a chart of industrial production. And once again, you can see where it drops off. And this is a long, old chart. It goes way back into the 20s, 1920s. And this is where it dropped off in 2009. Okay? And so you can see where industrial production, well, we had some boom years during the war years. Okay? And some real bust years in industrial production. This was the Great Depression in here. Okay, and you can see that we had some booms and busts until the early 60s. And then we started our cycle started to change, where we didn't have these tremendous booms, but we had positive results for much longer periods of time. So the booms and busts of the early industrial period had given way to slower growth, excuse me, but fewer downsides and much less volatility. All right, this is the U.S. unemployment rate. I wish we could have seen it back to the 30s, but you can see that back in the late 70s, early 80s, unemployment exceeded 10%. And then once again, it hit that back during the 2008-2009 period. Okay? And today, it is here, under 4%. Okay? And so you can see that there have been periods of time when unemployment has been that low, but not often, not in recent times. Okay? You've got to go way back to, about 1970, the late 60s, since the last time we had below 4% unemployment. And then lastly, this is wages. And you can see, going back to the 50s, that it's very volatile data, up and down, up and down. And these are the average wages, the wage growth rates. I'd love to overlay the wage growth for corporate executives. We couldn't fit it on the screen, it's so high. Okay? So these are some of the things that really drive the U.S. economy and the fundamentals of the stock market. Okay? People take a close look, follow these kinds of things very closely. All right, here's retail sales, a chart of retail sales. Right? And again, going back to the mid-90s, you can see that sales have been steady at around 5%, somewhere between 3 and 5% growth, until we hit the 2008-2009 period where retail sales just disappeared, and then they came roaring back up through here. So it looks like a good number is somewhere between 3 and 5% growth for retail sales. Okay? Then this is a really good chart of U.S. inflation, and you can see where inflation spiked going into the crash. So rising inflation led to rising interest rates, which led to our crash. And then, so here's the 0 point. You see we had disinflation or deflation during the Depression, deflation, which is very tough to control. And then we had inflation spike again during the war years, during production of the war years. This was cost push inflation. And then once again, inflation jumped. This was cost push inflation due to the oil crisis back in the early 80s, late 70s, early 80s. We had bad fiscal policy, bad monetary policy, and we had OPEC. And then since that period of time, things settled down tremendously, and you can see where inflation actually had a little bit of deflation back during the 2008-2009 period. But what are we looking for? Well, we want a little bit of inflation, somewhere around 2 to 3% inflation. Keeps things moving in an economy. Let's see what we're missing up here. Oh, this is a chart of the net profit margin for the S&P 500. And so you can see how profits jumped in the 90s. What is this from? Productivity. This is from the internet and computers. Okay? And then we overinvested, and profitability went, net margins went way down, sales went down, margins went down, and then they jumped back up immediately. And so we are still at very high profit margin level historically, at around 9% net profit margin percentage. And then lastly, interest rates. And so what I want you to take from this is that there's been a downtrend in interest rates dating back to the death of inflation. Inflation went down and interest rates went down. Okay? Let's see what slide we're on. We may take a little bit of a breather here. Let's see where we are. We are on slide 7. Let's see. Yeah, let's finish slide 8, and then we'll take a little bit of a pause. So we study the fundamentals, the economic fundamentals, to see how we think the market is going to do going forward. And the things we look at are government policies, the tax policies, the spending policies, the regulatory policies, the legal policies, and the monetary policies. And these policies have a very powerful impact on the business community and on psychology, the psychology of consumers and the psychology of business people, which in turn affects their spending and saving patterns. Okay? All right, what else do we look at? Population demographics, the distribution of the age groups has a big impact on fundamentals. Attitudes about saving and investing have a big impact on fundamentals. Okay? Education, very important to the productivity and the understanding of the people in our country about investors, that investors need to have. All right, technology, very important. Breakthroughs in technology in the late 80s, early 90s led to tremendous increases in productivity. Okay, so technology is important. Productivity is important. Natural resources, very important to a company's competitive position. Okay, when you think about Saudi Arabia in the Middle East, if they didn't have oil, they would have nothing. Russia, oil. The United States, lots of natural resources, great farmland and oil and gas. And if you combine technology with education, productivity, and natural resources, what you get is fracking in the U.S., where we developed a new way of drilling so that we can access oil and gas deposits. And the United States is now the largest producer of oil and gas in the world, once again, as it was 50, 60 years ago before OPEC. All right, what else affects the fundamentals? Natural occurrences, like weather, like earthquakes. They affect the fundamentals of an economy and the fundamentals of the market. And then lastly, geopolitical conditions. In the 90s, we had what's called the peace dividend, where the world seemed to be calming down, and Bill Clinton, as president, cut back spending on the military. He was not a big fan of the military, and we used that money in other areas. So the ebb and flow of political conditions really impacts economic fundamentals. Look at what we're doing to Russia. We're squeezing Russia. Look at what we're doing to Iran. Look at what we are doing to China with our policies, trying to bring these folks to change their behavior. Okay? China, what we're trying to do is get them to open their markets and stop stealing our technology. Russia, we're trying to get them to stop misbehaving around the globe militarily. Same thing with Iran. We want to bring them back into line, make them more peaceful, more agreeable. Same thing with North Korea. So all these things come into play when you're trying to assess how well an economy is going to do, and therefore how well financial markets are going to do, because the financial markets reflect the fundamentals and inflation and risk. And so all of these policies come into play as we're trying to determine, is this a good time to be in the markets or not so good? All right, let's take a brief pause. Shalom. Peace.